Now we can turn to what is the recovery going to look like? What are the estimates going to be? And here you can have, everyone has talked about, well, what about a V shape or a W shape or a K shape, or some will be better than others, or an L shape? The view that we've always had is that we were going to have a quick move down. We were going to have, that strong bounce off the bottom and then kind of go sideways at a slope that is yet to be determined, but it wasn't going to be a V shape. It was going to be something that was going to kind of grind along, especially as we have spits and starts in terms of where does COVID crop up, where do people start to see jobs coming back. And again, jobs is always going to be the bigger overhanging issue in terms of what does employment look like and how does employment come back. And here you can see the average of G7 recessions. You're looking at what is the average, what was the global financial crisis, and then what is the COVID-19 base in terms of where is that consensus forecast. And the bigger issue for us is just how quickly are we going to see that recovery, because we're starting to see things roll over a little bit. And again, it's just because we're coming into a point in time where we've had 10 plus years of central bank activity, of some government easing in some shape, way, or form in terms of deficits that continued, which is just going to create a bigger problem, because we had debt loads increasing. We came into this year with a record amount of debt, and we continue to hit a record amount of debt, which is just pulling forward that future growth, because we just are going to have to pay it off in some shape, way, or form, which is going to keep that recovery really depressed and kind of keep things, lower for longer, if you will. Another buzzword that always gets used. And now when we start to look at that central banks and the ability to finance increased government spending, when we look at the budget deficits, it's always important to appreciate what the budget deficit looks like and what the central bank asset purchases as a percentage of GDP, which we'll go through in a bit more detail. Anytime the Treasury is putting something out, specifically in the US, the Fed can show up to purchase it. Repos have gone to essentially zero, because, well, why would I want to borrow when I could just sell you some bonds and take in the cash to make up my shortfall? So this is where we continue to see central banks purchasing. The ECB is now at a record. We have a chart for that. We try to have charts for everything. So here you can kind of see how that growth continues and how the percentage of GDP is continuing to go up, especially as we see those budget deficits, which are only going to get worse, especially in the US when we think about, well, where's stimulus? How much is it going to be? Is it going to be 1.2 trillion, 1.8 trillion, 2 trillion, 3 trillion? I mean, at this point, just start throwing zeros on. And that's something where the central bank is going to have to show up and actually purchase those bonds to try to keep some of that, the bid to cover ratio relatively consistent, try to manage the yield curve. And that's why when we start to look at, who has room to cut interest rates, and this is where we start to look at, what is the optionality versus 2009 budget balance versus 2020 forecast. So here you can see, well, as we came out of the financial slowdown, at the financial recession in 07, 08, 09, what was the budget balance? Where were we? We had deficit spending because that's what you were supposed to do to try to get to the other side. Unfortunately, we didn't reduce enough. But here you can see just how aggressive things are happening, across the board. And the reason why is because of the law of diminishing returns. You need to continue to do more. You have to continue to increase in order to offset that. And that's why we continue to see some of these levels continuing to rise. And, at this point, those forecasts could get worse depending on what the new stimulus looks like, because that's what everyone keeps calling for. I mean, the market is up 200 handles on hopes of a stimulus because Trump said no stimulus to after election. We fell 80 handles. Then he said, oh, just kidding. We still don't have any stimulus, but yet we've recovered 200 handles. So always fun to be in the market where algos are in control. So the one thing that we like to look at is the Fed balance sheet. So when we started to get concerned, and there's a lot of reasons why this happened, but when all of a sudden you had a breakdown in the repo market, you had the Fed step in and start buying up treasuries, taking a more active role in the repo market, which is where we started to see that balance sheet increase. Then obviously we had a lot of action taken in March, which had that huge increase in the balance sheet in that level. And now you see that trend, that essentially the slope continues on the upward move, and that's because they're buying those new issues. Again, looking at ways to kind of manage of not only duration, but trying to protect the yield curve overall and trying to sop up some of that additional exposure as supply continues to grow, as the Treasury issues more debt in order to finance those balance sheets. Now, when we look at the ECB balance sheet, it hit fresh highs. There's really, that's not going to stop, just based on commentary that we've had from Lagarde, from other entities within the Bundesbank and others. You're going to continue to see this balance sheet increasing. And again, as it increases, there's more debt out there. You have more stimulus that's being pushed out. And even though we have all of this easing on a monetary and fiscal side, we're not seeing that same happen in terms of jobs. And the bigger issue is really looking in Germany on the furlough side. And it continues to be concentrated in that manufacturing sector. Again, coming back to exports, coming back to what is the real underlying economy doing. And the fact that there's still that many furloughs just shows there's just that slowdown in jobs. How are countries and companies investing? And it's really on the tech side to try to replace some of these people permanently. And that's why when you think of, why were these people let go? It's like, COVID, sorry. And then they were shown the door. Now that as COVID starts to not become the same issue, does that mean the jobs aren't coming back? And the short answer is yes. And that's why we continue to look at how many of those jobs won't be coming back, which is going to be that overarching pain that we're expecting, especially as we see that slowdown. Now, with that being said, we have to look at, what Eurozone industrial production. And here you see the industrial production in that white. Again, it missed estimates. It was down more than expected. And it was really the same as last month. And that's the bigger issue, is we're starting to see that stagnation and starting to see that rollover. Now, again, each country's different. Some, Germany had a little bit better than expected, but France, Spain was worse than expected. And that's going to be the bigger overhang of, have we seen that rally off the bottom, and now we're going to start to see that stagnation we've been talking about and that movement downwards. And when we look at German inflation as just a way to kind of gauge where things are, here we had inflation, we had deflation. The question is, where is that inflation going to come from? And when you have that much debt, because debt is inherently deflationary, that's where you're going to continue to see that pressure, especially as the ECB is doing more. The countries are trying to do more, and that debt overhang is real and is going to be that overarching problem. Now, again, talking about that French industrial and manufacturing side, the top is looking at the manufacturing, and it was slightly better than last month, but again, missed expectations. When we look at industrial production year over year, we continue to see these slowdowns where, the pace of that recovery is slowing. Now we're starting to see that rollover, which is just going to be that overarching, problem as we look at kind of what's happening on a go forward level. Now, when we look at driving, trying to get an idea of, we've had two refiners talk about, cutting runs, furloughing individuals in Spain and Italy, two of the largest. And it's really because we're starting to see this data slow down. We're starting to see traffic slowing, especially as COVID cases are starting to increase, which again is moving to the downward, that downward side, which with the UK also being a part of that. And as consumers, shoppers, people are inherently adjusting to this new normal, and they're trying to avoid some of that exposure. And it's really showing up where that traffic's starting to ebb down. And it's not only just traffic, but it's also, what are the shoppers doing? What are pedestrians doing? Because anyone who's been to Europe, there's a lot of these are walking cities. So what are the people doing? Where are they going? And here you can see that pedestrian traffic in major German streets are again starting to slow down, even though Germany doesn't have the increase in cases that some of these other countries have. It's just, we talked about furlough staying higher in key manufacturing areas. You have furloughs and joblessness and these issues, and then obviously you throw in, lack of tourists, and you start to see why we're starting to see that rollover, and that's going to be that problem that we continue to expect in the overhang and the overarching theme of slowing GDP, and that slower for longer. And then when we look at, we mentioned the UK, but here's that really aggressive drop off. And now, again, it's starting to stabilize. It hasn't, this is a little bit dated, so it's starting to kind of balance out at between that 85, 87 level. But again, it's starting. We saw the impact, and now we're seeing that, not that rebound, but again, things just kind of going sideways as there's that fear, as that consumer continues to weigh, and then throw in trade issues and Eurozone issues. This is one of those problems that is just going to continue to be an overhang to global growth as Europe as a whole, if you think about the Eurozone, the European Union in general, continue to see issues in terms of trying to get around that corner, which is, again, problematic for that oil demand, problematic for that reserve return that just continues to be the bigger overarching problem going forward.